What's up, guys? Welcome back. Malik here, and today we're going to be discussing two topics. I'm going to go through the one trade that I took today on the NASDAQ 100, and then I don't know if you've been paying attention to the news, but the US defaulting on the debt, we're going to be speaking about that as well because it's something that's going to take place whether at the start of June. So it's something very important. If the debt ceiling isn't raised, there are a lot of results from the US defaulting from the debt, and I'm going to actually use ChatGPT to explain it. And I'm also going to go through the last time something like this was about to happen and how the market actually reacted. So the first thing I'm going to look at is actually the trade on the NASDAQ 100. So I had one trade on the NASDAQ 100, and that was at 10:46 today. It was a downside trade. So I hit a downside trade um while the market was pushing down. So the market was basically drilling down. It had like a huge push down before like doing a doji candle, and then this can really trick people or stop out people. Say you enter to the downside here, your stop loss would be easily taken out as the market reversed against you. This can generally be a bullish sign, like it's going to tell you the market is going to push up. It's just clearing out all of the stop losses. But at the same time, I went with my strategy, took it to the downside. Actually, at the start of the trade, I didn't set my stop loss. So it turned out to be a little lucky because after that, they had a liquidity grab on the next candle. So if the market had continued reversing and going up, I would have lost a lot of money there. But then because it was like a liquidity grab, it pushed up and came right back down, started to push back down. That's where I was in profit for most of the time. However, there was a big candle again that kind of cleared out the liquidity again. Like you could see where everyone's stop loss was. It kind of came back up and pushed out. So you can see at 10:46, I entered with a 0.03 lot size, entered at 13346.5, entered here to the downside, and then I got stopped out here as it reversed against me a little bit above the candle that I entered in at 13350.6. That was within an hour of price moving, and then I lost a total of $1.23 on this trade total because I'm still keeping the risk very small until I see that consistency, because something like this on a large position size would have really thrown me off because the market still went down in my favor, still went down the way that I wanted it to. But because of these sporadic candles or these liquidity grabs, I could have easily been taken out. Say I was risking $100 and it went up like this, I could have just cleared out maybe $500 within 15 minutes. And then that itself could have thrown off my psychology and had me trying to revenge trade and make back the money, right? So that's basically the only trade I took today. So you can see I took 3 trades for the week in total. That puts my win rate at around 33.333% because I had 1 win and 2 losses. And then basically that was it for today. Just making one trade. Didn't go as expected, but there's more room to kind of fine tune the strategy and see where I can find more consistency in the strategy. So the important news that I've been seeing is that there's a possibility that the US will default on its debt. If you want clear answers to your questions, I mean, it's easy to just go to ChatGPT and see, just ask it the question. So I typed in what happens to global equities and US equities if the US defaults on its debt. So defaulting on the national debt is generally considered a disastrous scenario for any country, and it would likely have severe consequences for both the US and global economies. So this is not something that only affects the US. Like if the US defaults on its debt, it's going to affect all equities all across the world, right? So the US has never defaulted on its debt, which means the US always raises the debt ceiling, and then the US can basically go into more debt to just keep the ball rolling, essentially, right? So it has never defaulted on its debt. I don't think this will be the time, but there will be a lot of uncertainty going up to that date, which is around June. So doing so will likely lead to unpredictable and far-reaching events. The following impacts are probable, but they are conjecture based on economic theory and historic examples. So the first possible outcome is plummeting equity markets. So US equities would likely plummet in response to a debt default. The default would inject a massive amount of uncertainty into the market, and investors may respond by selling off risky assets like stocks in a flight to safety. Right? The next possible outcome is a loss of confidence. A US default would lead to a significant loss in confidence in the US economy, both domestically and internationally. This is also bad for US bonds, because if they lose confidence that the US can pay their bills, why would I borrow money from you to do anything? Why would I basically pay for a treasury bill in expectation for a return in the future when you can't even pay your debts now, right? So if you don't have anybody purchasing US bonds, that's no money coming into the US, which is very bad as well. There's also a credit downgrade, and this was the key. This was like a key point that stuck out to me. So a credit downgrade. So credit rating agencies would likely downgrade the US, as in the country, following a default, which would raise borrowing costs for the US government and potentially for US businesses and consumers as well. So that would make like the entire quality of life for everybody in the US very differently. So I actually typed it in. The last time the S&P downgraded the US was in August 5th, 2011, right? And the last time that happened, let's go to August here, 2011. It seems like you had some first movers because this is July 28th, 2011. And you had this big push down. Let's see, August 5th. August 5th was this candle, like it was a pretty small candle. And then the next one was a huge push to the downside. And then the one after that was a huge reversal. So, if you took a short position, you're cleared out on the next day if you didn't sell out. But you can see where that push down actually erased a year worth of gains on the NASDAQ 100. So it's possible we'll see something similar, like even if the US still raises its debt ceiling, the S&P might still downgrade the US, as in the credit rating, and make it harder for them to borrow money, thus making the entire economy like more expensive to operate, right? So let's go into 4 now. So ripple effects. The US economy is closely interconnected with the rest of the world. A US default could create a domino effect leading to defaults in other countries and a potential global financial crisis. So you can also have an economic recession, and we are already having a recession. So imagine a debt default on top of that. So the financial turmoil could trigger a recession, which would likely further depress equity markets. And then we also have monetary policy impacts. In a response to a default, the Federal Reserve might take actions such as increasing interest rates to combat inflation. Increasing interest rates. We're at 5% or 5.25 interest rate from the Fed already. We're at high interest rates, and the Fed has no intentions of cutting. And they're saying response to the US defaulting is the Fed increasing interest rates. And I believe they're increasing interest rates to make back the money to pay off the debt. So they're saying, remember, this is a highly hypothetical situation, and the real world outcomes could be quite different. It is also worth noting that the US government has tools at its disposal to avert a default, even in the face of significant debt burden. That's very interesting. I mean, this is a US based software platform, so it has to kind of show some bias or support to who it kind of operates under. So you understand that there is some leaning towards the US there, right? So that's basically it for today. That was the last time the US got downgraded. That was before they thought that the US would have defaulted on their debt. When they didn't default and they raised the debt ceiling, the S&P basically looked at how the US operates and said, you're not really good for the money, and kind of change the credit rating. So thus it makes the US harder to borrow money. It makes it harder for the US to borrow money as a country, and it might affect the standard of living for the businesses and the consumers in that country if the country were to default. I'm not sure if this is going to happen, but I know that a lot of traders are predicting a lot of turmoil, especially in the week before the debt default might come around, which is around June. The first week in June is when it is supposed to happen. So if we don't see anything come about before the week before the first week in June, the market is probably going to sell off just based off the uncertainty and people trying to front run the move in the markets, right? But that's basically it for today's video, and I'll see you in the next one. The global debt